Good day, and thank you for taking the time to watch this video. My name is Matt. I'm the IT analyst at PSG Wealth. We've recently released a report on Naspers and Prosus, so the point of this video is to go over some of the key points from our report. On a year-to-date basis, Naspers is down about 35%, Prosus is down 41%, and Tencent is down 24% in Rand. The weakness in share price can be attributed to three main factors. Number one, Tencent. Tencent is the primary driver of the Naspers Prosus share price, and Tencent itself has had a huge sell-off amongst the increased Chinese regulation. Number two, the Russia-Ukraine war has forced the market to look at the exposure in Russia and Ukraine. Prosus has 4 assets exposed to the region, and the invasion has triggered a sell-off in both Prosus and Naspers. And then number three, the holding structure. Recent events have highlighted that it is very difficult for management to unlock value, and this has resulted in a widening discount. In light of this, we've updated our valuation and focused on the holding company discount. In this presentation, I want to focus on the breakdown of the holdco discount after discussing the drivers of underperformance. As recommended in the report, we've got a hold on both Naspers and Prosus. So just looking at performance in the last month, which is March, we've had 3 days where Naspers and Prosus have each lost 10% in a single day. We've had 1 day where they've both gained about 20%. Prosus is trading well below its listing price, and Naspers is in the red over 3 years. Over 5 years, Naspers has underperformed the JSE Cap-Swix, and all of this has happened in the space of a few months. This is a risky company, and it's no longer the market darling that it once was. So let's look at the drivers of underperformance. So we've got Tencent and Chinese regulation. We've listed a whole page in our report of the regulatory events that have happened in the tech sector since the end of 2020. It started off with the cancellation of the Ant Group IPO. The Ant Group is mostly owned by Alibaba. We've also seen, although small, we've seen numerous antitrust fines charged to players in Chinese tech. We've had WeChat user registration suspended temporarily. We've had the Chinese government declaring the private education sector, declaring that it can no longer make a profit. And the long story short is that the Chinese government is unpredictable and they act swiftly. This is very different to how things are in the West, where new legislation and laws tend to move slowly and they jump through multiple layers of voting and approval, which is transparent. China does not operate like that, so it is very difficult to predict what the next move will be. Because of this unpredictability, anytime something happens, we see a lot of panic and contagion across the tech sector. And in this last year in particular, many people are starting to question whether China is investable. Now, in February 2022, the regulatory environment started heating up again, and it has scared the market. This has impacted Tencent, which has impacted Naspers and Prosus. The second driver of underperformance is Russia's war on Ukraine. So Prosus is exposed to Russia and Ukraine through 4 assets. The largest one is Avito, which is a Russian classifieds business. This has got the biggest exposure, but the last update from management said that they are going to continue operating this business where possible. Both revenues and costs are denominated in the Russian ruble, so it will affect the reporting, since the reporting is done in US dollars. The second asset is OLX, the Ukraine business. It's very small and they're going to continue operating where possible. The third one is PayU. That's a fintech company with a global revenue stream. Only a small portion of that revenue comes from Russia, about 2%. And then The last asset is VK, which is formerly known as Mail.ru. That's the Gmail and Facebook of Russia. That's going to be written off by Prosus. It was a listed, or it is a listed asset, and the value at the time of the Russian invasion was about $500 million. In total, we estimate that these assets combined are about $4.5 to $5.5 billion. Before the sell down, which was mid-February, it was about 3 to 4% of Prosus market cap. And as we've seen, there's been a lot more than 3 to 4% wiped off since the war started. The blue circle here shows the size of Prosus versus the size of the assets at risk, which is the small black circle. The last driver of underperformance is the cross-holding structure that was implemented last year. It has largely failed to reduce the discount, and it's actually created a double discount. There's an agreement between Naspers and Prosus that there will be no change in the structure for at least 3 years, which further creates difficulty in unlocking value. In addition to that, Naspers and effectively Prosus is controlled by non-listed Naspers A shares. So shareholders have very little say about the goings-on, and this makes it very difficult for shareholders to do anything to get that trapped value unlocked. So I just want to spend some time on the valuation, and the valuation is quite simple. The net asset value driver is 10 cents, but the intrinsic value driver is the discount applied. So the big question is, what is an appropriate discount? If you're positive, you're going to apply a smaller discount. If you're negative, you're going to apply a higher discount. What we've tried to do here is remain as objective as possible. So our discount is made of 3 components, and the breakdown is included in the report. The components are: 1, a holding company discount, which is the average South African holding company discount, which is between 30 and 35%. We've added a further 10% to account for the VIE risk. This is based on the probability of a binary outcome. So that's either VIEs are legal and nothing changes, or they're outlawed by the government and the Prosus ownership of 10 cents is worth effectively nothing or very close to zero. And then lastly, we've added an additional discount of 5% to account for strategically sensitive assets. So just like private education, this is to account for further interference by China on assets that are considered strategically sensitive. And Tencent has got a few assets which could be viewed as strategically sensitive. One is gaming. So they view gaming as a hindrance on the long-term growth of the Chinese economy. Also through WeChat Pay. Almost the only way to pay for anything in China is through WeChat Pay. So there are certain assets that Tencent has which the government could and has been quite tight regarding regulations. All in all, this comes to about 50%, and this 50% is in line with SoftBank, which we view as a proxy because it is exposed to very similar assets. Its main asset is Alibaba, and Alibaba is exposed to very similar risks to Tencent. It's got the VIE risk, it's got the Chinese regulation risk. So this gives us comfort that our objective discount is fair. So with these discounts applied, we are very close to the intrinsic value at current levels, which leads us to the hold recommendation. And bear in mind that these 3 stocks are extremely volatile. It's very difficult to call which direction they're going to go from here. But I do think they'll hover around these levels for a while. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, you can find our report on my base, and I just wanted to thank you for taking the time to watch this video. Before we end off, please take note of the following disclaimer.